Um, okay. Oh, okay. Welcome back. So I'm not gonna show the video of myself because I was trying to use Zoom and then I lost about 40 minutes recording. So I'm gonna switch back to Katora. So I and just like that. Okay. So let's keep talking. I mean, my face is not important, and we can already summarize some important thing about this chapter. So I just want you to focus on how do we reconcile bank reconciliation. Okay. So part B, we start talking about what is cash. Um, so cash is actually it's more than what we know in general. It's instead of like a $10, $100, $50 bills, we call that a currency, right? So there's a coins as well. So that's what we know. But actually, as long as the company receive checks, right, and they have a saving account and they have a checking account, all these things are being considered as cash. At the same time, credit card sales and debit card sales are also considered as sales. The reason is if the company have a terminal of the Visa terminal or MasterCard terminal, those money that the customer pay over credit card or debit card will be cleared less than 24 hours. So that immediately can consider as cash. And also there's a cash equivalent such as treasury bill and certificate of deposits. They can also be considered as cash as well. And then you will ask me, say, then what is not cash? So remember, cash has a high liquidity, right? So let's look at this example right now. Which of the following would not be considered as cash equivalent? Credit card sale for the day, we already talked about, definitely cash. And debit card sale, definitely cash. Check received from customer, definitely cash. And the certificate of deposit that matures 1 year. How important is reading? So matures 1 year, that certificate is not considered cash because one until 1 year from now we can liquidate it, we can use this fund. So right now it's not cash, it's not something we can buy stuff, right? You cannot give someone a certificate of deposit that matures 1 year to buy food. Okay, let's um so the after that, after we understanding what is cash, then why is the internal control and the cash should be one chapter? The reason is that internal control is to preventing uh, fraud or theft happening, and the cash is most vulnerable asset of the uh, company, right? Hence, that if you have a weak internal control, then the cash is most vulnerable asset will be stolen. So therefore, we wanted to understand the importance of setting up cash control. So cash controls can be considered from two sides: cash receipts, which cash inflows, right? And cash disbursement, cash outflow. In order to safeguard our cash inflow, each day there should be one employee open the mails and list the checks. First person, different person. Okay. Second is that each day a different employee should deposit a cash or check to the bank. This is the second person. Third person, as soon as possible, a separate and not a separate employee should report the cash receipts in accounting report. A third person. Okay. So then we also need to make sure that the amount of the cash, which is the bills and the currencies handled, is limited, and we should consider diversify our risk by accepting debit card and credit card. Okay. And then when we talk about the controls over cash disbursement, which is cash outflow, we will talk about, first of all, disbursement should be made by check, debit card, or credit card. Yeah, handling currency is very kind of dangerous. Uh, like not safeguard your cash, because cash, once you pick up cash, it does not return anyone's name, right? They claim on. And second is authorize all expenditures. So there's a certain procedures that the employee should follow to be able to use cash or prepaid checks. Third is that check needs to be serially numbered and should be required at least 2 signatures for large amounts. There's a lot of check fraud by manipulating the signature, by manipulating serial number to clear company's check. Okay, you can see in the movies, you can see in real lives. Okay, the fourth one to safeguard check is that, or cash is periodically compare debit and credit card statements to purchase receipts. In other words, saying if you have an employee credit card or given for like 200, 300 person, you need a system that to ask them to report how much they are actually spending by using your credit card. Right? So there should be a periodical reconciliation of the spending and the card. And the fifth is that you got to set up the maximum purchase. If you say I set up the credit card limits for 2,000 for executive or for employee, if there's someone spending more than 2,000, then there will be set a red flag saying that okay, go check what's happening to this employee, what they did. Okay. And then third is the separate cash disbursement and cash receipt duty. In another word, the person who oversees cash outflow should not be the same person who oversees cash inflow. Okay, so now we are pretty much talk about the most complicated concept of this chapter, which is reconcile bank statement. And then before we jump on that, I just wanted to give you a pictorial or a little bit more like a simplified picture of what is a bank reconciliation. So consider everyone have a checkbook, right? So usually if you remember, so you remember how much money you have, and a bank remembers bank remember how much money you have is usually does not equal, right? That because sometimes you forget something to record, right? Or sometimes you thought you already record something and bank didn't record. And sometimes the bank record something, or bank received cash and you didn't remember. So therefore, in the end, for us to get a number equals each other, the book that you record, and the book bank record need to be record each other. Is to record is a bank needed to record the things you collected didn't tell the bank, and then you needed to record the things that bank reported didn't tell you. Okay, it just simplify like that. And okay, let's look at what I meant. So the balance of cash in the company's records may not equals to the bank balance of cash in the bank record, right? So there's two possible differences causing a company's cash records, which is the cash account, right? So usually you have a balance here, and the bank statement. So say March 31st, there's $1, right? So those two might not equal. There's two possible cause. One is timing, one is error. Okay, so hence the bank reconciliation is trying to match the balance of cash in the bank with the balance of cash in the company's own records. So what's the timing difference? Timing difference occurs when a company records a transaction before or after the bank records a transaction. That means that sometimes you recorded, like I said, and the bank didn't record, and sometimes bank record and you didn't record. Errors is the result from mistakes either by bank or by you. Okay, let's look at an example. So this is the company's records of the cash activity. Basically, it's the T account, but just listed in more detail, right? So this is cash T account. So it shows that the increases, which is item on the left-hand side, and the decreases is the item on the right-hand side, and then there's a balance. So is a cash receipt side. You have a March 5th, 22nd, 23rd, 31st, right? You in total you received $7,780, and then cash disbursement during the March is actually 8,700. So to calculating the ending balance of the cash, we learned from chapter 2 is that beginning balance plus cash receipts minus cash disbursement, we find this actually 2,880. Right. Remember this number, it's handy later. Okay. And now let's look at the bank statement of the company. The bank statement, you see, this is the first bank, and it says on March 30th, 2021, the balance is actually 4,100. You say, oh, the book cash balance is 2,280, and the bank balance is 4,100. So there's a difference. So how do we reconcile them? Step 1, we always start with bank side. We want to make sure the bank's number is correct. So we first reconcile bank side. So what kind of thing causes bank side cash balance is wrong? So cash transactions recorded by the company but not yet recorded by the bank, that will make bank cash balance wrong. There's a two scenario in terms of a timing, causing by timing, and the one is causing by human, right? The timing is two. One is called a deposit outstanding, another one called a check outstanding. Deposit outstanding means cash already received by the company that have not been added to the bank's records yet. So in other words, the accountant already aware of the receipts, cash inflow, but the bank did not know yet. Okay? Check outstanding the opposite way. Check the company has already written that has not been subtracted from bank records yet. So that means you already know check already fly out, but bank did not know. Bank does not know yet. Okay. There's only these two scenarios will cause bank's cash balance wrong. And the third scenario, of course, is human error, right? Bank can make mistake as well. The second step is to reconcile company's cash balance. Okay, so what kind of mistakes then the company can make, right? First of all, or not even mistake. We said there's two possibilities. One is timing. It's also again caused by timing. One is error, right? So what is the timing related? First of all, cash transaction reported by bank but not tell the company yet. Common items that should increase the company's cash balance, meaning that this item will increase in the cash records that you keep tracking. For example, bank already collecting on the company's behalf, or the interest earned on the average daily basis of our saving account or checking account. So another possibility is that common items that will decrease the company's cash balance. So this will increase, right? This following item will decrease cash balance of the book. First one is electronic transfer. Sometimes when the company dealing with the suppliers or the customers or any parties, they can directly access the funds in the bank without even go through, say, human interfere, such as ask the accountant to prove and then, go to the system, go to the bank system to pay for it. They can directly get the electronic transfer number and get money out of your checking account or your saving account. So that means that bank already electronically transfer the funds to the third party without telling you who is the accountant. This will cause the cash balance decrease of your company's book, right? And another thing is a non-sufficient fund check, which is a customer's check written on non-sufficient funds, meaning that the check that customer gave to you is bounced, meaning you already consider this cash being received. And then you give this check to your own bank, wanted the bank to clear it. But the bank says, this check is a bad check. So the customer did not have enough fund to cover the value of the check. For example, the check writes, say, $1,000 on it, and you received this check, you debit cash for 1,000, right? And you credit accounts receivable for 1,000, say from one customer. But this check went to the bank, and bank said, this check cannot be cleared. Hence, that you are recorded extra $1,000. That is not true, not right. Then this kind of situation you should reduce your book balance, cash book balance. And third scenario is that debit card purchase, that you give your employee a debit card to use, and then they didn't tell you, or they didn't report back, or do employee reimbursement program. Hence that you did not know they spent the money, but they did, and bank did. And then that's why your cash balance is higher than what it should be. And the last one is bank service fee. Usually bank charging at least $50 to $1,000 sometimes, depends on what kind of bank card you have. So those fees are kind of secretly charged. If without doing bank reconciliation, you would not know if they are even there. So that means that bank already reduced your checking balance, your cash balance, and you did not know that, right? So this will decrease your company's cash balance. And last one is the company if you made mistakes. So this kind of like very intangible. Let's look at one example. The example we wanted to say here is, let's look at this example, right? So what happening here, from the cash collection purpose, this company did an investigation. Company recorded 3 transactions, okay, and bank recorded 4 transactions. Out of this, from company perspective, 2 transactions matched with bank statement 2 transaction. The $3,600 received, right? Both sides received, and then 1,900 both sides recorded as well. However, on the company's records, right, you recorded at the end of the month there's a 2,200 deposit outstanding, not in the bank yet. On the bank side, bank actually received $3,000 on our behalf. Out of this 3,000, there's a 200 interest and 2,800 note receivable, right? At the same time, bank gave us $20 interest revenue, right? So these things are secretly bank already handled for us, but we did not know. Okay, this is the cash collection side. Okay, let's look at the cash payment side. So from company's perspective, there's a 5 transactions happen. Okay. From bank statement perspective, there's 7 transactions happen. And comparatively speaking, we can only find 3 transactions both recorded correctly in both sides. Say the salary paid for 2,100 is recorded in the bank and in company's book, and $2,600 for the rent is recorded, but there's a mistake because bank said we actually paid out the 2,900, but we only recorded 2,600. Okay, there's a mistake here. And the third one is both existing both sides is the insurance expenses for 1,900. Bank recorded and we recorded as well. Besides that, out of the six transactions in our book, there's utility bill and supply bills that we already write a check, but has not been notified the bank yet, right? Bank did not know that we paid out these 2 checks. the vendors, utility vendor and supply vendor didn't clear the check yet. On the bank side, look how many transactions actually happened that we did not know about. First of all, there's the electronic fund transfer for $400 transferred out from bank we did not know. And there's a bounced check for 750, non-sufficient fund for 750 we did not know. And there's a 200 debit card purchase we did not know either. And there's a $50 service fee by bank we did not know. Okay, not cash decreases in the bank and not recorded in the company. Okay, so what do we do now? As we stated the first time, step one is to fix the cash balance on the bank side. So we remember the money in the bank is 4,100, right? So first of all, we want to add in the deposit outstanding for 2,200, right? Because in the book, remember, in the company's record, the book says we on the March 31st, we have 2,200 recipient of the cash, but the bank did not know, hence we adding 2,200. And also the book record the utility and supply expenses, one for 1,200, one for 900, and bank did not know yet because the check is outstanding. So we will minus 2,100. Hence we get a final number of 4,100 plus 2,200 minus 2,100 is 4,200. Okay. Okay. So step two is we are taking care of the company's cash side. Remember, the company's balance is 2,880, right? So the first thing is that, remember, the bank, look at here, bank help us to receive the notes receivable for 3,000, right? And this is 3,000. The 2,800 is note receivable received, and $200 is the interest earned on that note. And also bank give us $20 interest on the bank account that we have, right? So this taking care of the company's cash balance that should be increased portion. Okay, and then we want to look at the company's records that bank recording the cash disbursement, but we did not record yet. So first of all, look at the non-sufficient fund 750. We thought we already collected, but we didn't because the bounced the check. And the second is the debit card purchase, right, for equipment for 200. We didn't record, hence then we're gonna reduce that. And electronic fund transfer for $400. We did not know, and bank already helped us transfer. And service fee that bank charges for 50, and we did not know. We need to record it. And that's $300. The arrow, the human arrow for 300. Remember, the rent. So at the beginning, remember we actually debit the rent expense for 2,600 and a credit cash for 2,600. But bank said we actually spent 2,900. Look at here. Okay. Look at here. This means that we recorded our cash payment for rent. Like I said, debit rent expense for 2,600 and credit cash for 2,600. But the bank says, wait a sec, you actually spending 2,900 on that rent, right? The same check number. So that means that we omitted the $300 expenses, rent expenses. Hence, right now, in order to correct it, we needed to reduce this $300, right? Because our record is short 300. So after that, we got 4,200 and we balanced. Okay. So let's see some concept check. So which of following item would be found on the bank side of the left-hand side of the bank reconciliation. So bank side is only timing differences equals error, right? Timing differences only stands for deposit outstanding or check outstanding, right? So therefore, deposit outstanding. So choose B. So then you will ask me, okay, then what is A then? So A, interest income received on the account. So what is that? That actually means that bank give you some interest income and you did not record it. So this will be adding the book side, right? And a non-sufficient check from a customer. Oh, so you thought the customer paid you already and bank said, no, we didn't get the money because it bounced the check. So you have to reduce your book side, right? And then D is a service fee charged by the bank. Service fee charged by the bank, you did not know what the bank did already, so you have to reduce your book, right? So all these things happen on the book side, which are on the right-hand side, and the question is asking bank side. So therefore, B. Okay. Okay. Concept check. How would an NSF non-sufficient fund check from customer to be treated on the bank side of reconciliation? Yeah. So it should reduce the bank company side, right? Because NSF fund bank already know, but the company's cash balance doesn't know yet. Therefore, you have to reduce. In other words, a non-sufficient fund check would be shown on the company side, on the right-hand side, and it would be shown as a deduction. This is because when the company originally deposited the customer's check, they increased the cash account already, right? Because when we receive the check immediately as a content, we debit cash, credit accounts receivable. Now, that check has been discovered that to be a non-sufficient or in non-sufficient fund check, or company must reverse that cash out from the book. Basically, you have to, this is wrong. Then what do? We will debit accounts receivable because the money is really not received yet, and we will credit cash, resulting in a decrease in deduction on the company side. Okay. So step 3, we will update the company's cash account by doing debit or crediting cash, right? So we examine items used to reconcile the company's cash balances, and we debit cash for items added to our book cash, right? We're gonna debit, and we're gonna credit the cash for the items that's subtracting from the balance. Using this example, I just cut the company side the cash balance reconciliation, right-hand side one. So first of all, the note received interest on the notes and the interest revenue from the bank should be all credited, right? Credit the note receivable, interest receivable, because we already received cash for it. And then also we will recognize interest revenue because bank give us $20 interest by having a saving or checking account, only saving account. And then also we want to record the items that decrease cash balances. For example, the advertising expenses for $400, which is using by EF, electronic fund transfer, right? And we will debit accounts receivable because the non-sufficient check, right? The customer that gave us 750, we saw it's actually a real cash check, and then the bank told us no, it did not clear. So this is NSF funds. And the supplies that being used to buy debit card purchase, right? For that $200, we will debit the supplies. We will also debit bank service fees as expense for $50, right? Because bank charges us and we did not know that. And then the rent expense that we recorded short for 300. Now we have to bring up to the correct balance, correct the rent expense error for 300 by debiting it. And all of this are cash outflows of our book balance as we credit cash. for this much. Okay, 1,700. Okay, in summary, from bank side of the reconciliation, we first starting with the bank statements balances, and we adding the deposit outstanding and minus the check outstanding, and the plus or minus the bank side of arrow to get the correct balance of the bank. And then we move on to the company side of cash balances. We're starting with unadjusted general ledger balance of the cash account. We were adding notes received from the bank and interest received from the bank. At the same time, we're going to minus non-sufficient check received because the customer didn't have enough money. We will reduce our cash balance of general ledger cash balance. We will reduce unrecorded debit card purchases or payments. We will record unrecorded electronic fund payment. We will minus the bank services fee, and also we will adding our arrow minus the arrow caused by the rent expense, right? And then we got the bank side of the cash balance. So this thing has to equal. That has this bank, then if it's equal, then we did a good job. Okay. So if I have to examine you, I will examine you the non-sufficient fund check example. So remember to study this. How would a non-sufficient fund check from a customer be recorded in the accounting record? It should be restated, right? So at the beginning, we receive this check without knowing it's non-sufficient fund. We will debit cash and credit accounts receivable. Once the bank find out that this check is actually not having sufficient fund, we will restate the accounts receivable and decrease our cash balance. So we choose A. Okay. Okay. So then we will talk about the account for employee purchases. So usually the company wanted to set up a cookie jar, which we call the petty cash. So it's a cash fund that can access by employee without credit card, debit card, or without any kind of authorization. It's for convenient purpose. It's a small amount of cash kept on hand to pay for minor purchases. Okay, and the accounting for the petty cash fund involves, first of all, you have to establish this fund. We will do an exercise at the class. And we were recognizing the revenues from the fund, and we always replenish the fund. So for example, you always have a cookie jar, which is a petty cash fund for, like, say, $200. So by paying pizza delivery for the meeting, by buying supplies or toner for the company. So those things are maybe is cash driven, more likely. Hence that you will always replenish that $200. Okay. And then another thing is if you want to handle cash related events related to employee purchases, we usually actually doing credit card nowadays, or debit card. Debit card is pretty rare actually. Credit card is most prevalence, right? Debit card actually can essentially consider as a check. And the credit card purchase need to be recorded, right? Debit card captured in the bank reconciliation, because whenever there is a debit card purchase, usually nowadays you're gonna get notification. Credit card usually needs to be recorded. Let's give you an example. So first of all, how do we establish petty cash of 200? We will debit petty cash accounts, right, and credit out our checking account for 200. Remove cash from the bank and place it on hand at the company. So petty cash it just means like a currency in the office, a small box that you kept it safe, and hence that it will taking out from the checking account, cash checking. Okay. So employee purchases, for example, use petty cash to purchase lunch and deliveries, and using credit card to purchase supplies, and using marketing manager using credit card to purchase advertising and postage. So as you can see, for launch deliveries, the 150 is called the entertainment expenses for launch and delivery expenses for $90. We will credit out this, not the petty cash account, okay? We directly credit the cash account, okay? And second, so when we're purchasing the supplies, advertising, and the postages, those expenses, we actually generating accounts payable because our credit card, right? Because when you use a credit card, in the end, you will do what? You will look at the credit card. So you get a credit card a statement, right? They say this month, um, September 30th, you have a balance of $10,000. Say this $10,000 is what you owe the bank, right? Hence that if you're ready to pay off the balance, you should debit accounts payable and credit cash. Hence that during the September when the purchase manager and the marketing manager using company credit card to buy supply and postages and advertisement expenses, you actually record as accounts payable, okay, for this much money. Okay, I think we did a good job in chapter 1, talk about the cash flow statement, and we will do some exercise in the class, but we're not going to talk about it in detail here. What I wanted to talk about is actually the purpose of cash flow statement. So first of all, bank's balance sheet is relating to cash because there's a balance of the cash, which is the beginning. So balance sheet, the asset side, right? Really the first thing, the current asset, the first thing is cash balance, right? And then what it meant of this number, say $20,000, it means that a snapshot at the end of this period that how much you have in the bank as asset, and it's whether it's current or non-current, right? And statement cash flow, this is very interesting. Cash flow statement is actually detailing telling us the inflow and outflow, right? And it covers a period of time. It's almost like an income statement, but the subject of it is actually cash. And it's separating into operating, investing, and financing activities. I know all of you had a little bit of trouble to find out what differentiated between operating, investing, and financing activity. And then here I wanted to reiterate it because operating activity is transaction, cash transaction involve revenue and expenses, which is normal business, right? The things that are related to the business, such as cash received from customer, cash paid for the rent, supplies, and salaries. And the investing activity is talk about cash investment in the long-term asset or investment in securities, right? Such as purchase of land, sale of land, equipment. And financing activity, as we talk about, it's related to two people, bank or stockholders, right? And then definition is a transaction designed to financing the business through borrowing from the bank or own investments. Okay? Issue common stocks or pay dividend or borrow, repay a debt. And I know right now we talk about this a little bit because we want you to remember it. Okay? So the last topics that this chapter is talking about is analyzing cash. So we wanted to use an example, Regal Entertainment and Cinema. So I wanted to demonstrate the linkage between the cash reported in the balance sheet and the cash reported in the statement of cash flow. So in the balance sheet, okay, the cash and cash equivalent on 2016 is 246.5, and cash and cash equivalent at 2015 year end is 219. So the change is 26.9. Okay, so how is the linkage between balance sheet and the statement of cash flow is that? So the change of 26.9 you will find in the statement of cash flow of 2016 year end. In other words, the difference between 2015 2016 cash balances difference can be reconciled or can be found in the 2016 cash flow statement. And then, in other words, cash flow statement give us a detailed explanation of what happened to the cash between 2015 to 2016. Similarly, Cinemark Holding have a minus 27.3 decreases in the cash balances from to $588 to $561. There's a $27 cash decreases, and then from the cash flow statement of Cinemark Holding, you can find out why there's such decreases, because they have a lot of investment opportunity, investment cash flow, outflow, right? Okay. So therefore, let's look at the cash holding status. So usually we will pay extra attention to cash because cash, remember, cash is the king, right? And then, so normally we have a liquidity ratio or cash ratio is to use the cash or cash equivalent dividing the total asset. So in this case, that Reagan Entertainment have $246.5, I believe is in millions. And then the non-cash asset is $22,399. So the cash ratio is about 10%. And Cinemark Holding, the cash ratio is 15% because the holding cash balance is the 561 dividing 3,745 equals 15%. Okay, so let's look at which of following statement is true. A, having too much cash represents the idle resources that are not being used to produce revenue. It could be true. If you have too much cash idling around, it's not a good thing as well, because you can invest using the cash to purchase equipment, land, or invest in other securities to get returns. Because holding cash does not bring you more cash. Investing bring you more returns and cash, right? If you have too much, that means you are not using your resources efficiently. B, one way to assess cash holding is to compare cash assets to non-cash assets. That's true, right? By only look at the cash balance, it does not tell you how proportionally how much cash this company has, unless you're comparing the proportion of cash with the total non-cash asset. Then you can understanding whether the cash is overholding or underholding. And C, in recent years, cash holding have increased tremendously. Yes, this is exceptionally true for the multinational company of US, because US company have a rule saying that if you park your cash outside of US, not bring it back, they will not be taxable. Hence that like Apple, they have a very high cash holding on their balance sheet is because they refuse to bring their sales, say from other continents back to the homeland, because once they bring back to the homeland, they will be taxed again. Hence, that's Apple willing to park all their cashes outside of the United States to avoid tax. That's why in recently, cash holding are more increasing tremendously. And that's why the D is correct. Okay, so I wanted to give a summarization of this chapter. This chapter, in terms of problem solving, I think the bank reconciliation probably is the most complicated topic, which we will do adequate exercise during the class. And conceptually, I want you guys to understanding what is the internal control and what is the Sarbanes-Oxley, what is the fraud, right? So why there is a fraud triangle, the three factor, and then what happened to the U.S. History related to accounting fraud give birth to Sarbanes-Oxley 202, that law, and what is the most important thing that law talk about, right? And then the internal control is such significant concept after that law, and then related to four factors or four components controlling environment risk assessment, control activity, and monitoring. And then we talk about the preventive and detective control mechanism in terms of control activities. You don't need to memorize all this, but you do need to understand what they meant, why they all exist. Okay, and then we talk about what is cash and how to safeguard cash, and then we'll talk about bank reconciliation. The rest of it talk about the cash flow statements. I believe we had a good foundation on chapter 1, chapter 2, as I'm not worried. And then establishing petty cash accounts. I think you guys gonna learn like 1 second. Okay. So I think this is a relatively easy chapter, and I believe you can find a good, will find it easy. And then I'm looking forward to seeing you guys in the classroom. Okay, thank you.